Good evening. We begin tonight as Wall Street suffers its worst day in 2 years. The Dow falling more than 1,000 points. You saw the close a second or two ago. The S&P and the Nasdaq, broader markets and tech stocks down 3%. And take a look. Just look. Intel off another 7. Every stock in the Dow is lower, and it is tech, Amazon, Cisco, Apple, Intel that are bearing the brunt. Even the value stocks, P&G, Caterpillar, Walmart, Home Depot at the top of the market, they are still falling, but by no means as much. It is anxiety. The selling started in Asia. Japan, good grief, 12.5% off. Seoul's Kospi down nearly 9%. And in Europe, much more modest losses, but still sizable nonetheless. Investors are worried that the Fed's waited too long to cut interest rates. Quincy Krosby is the chief global strategist at LPL Financial. Now, Quincy, let's accept that markets, like pendulums, tend to overreact one way and then the other. So there's an equilibrium that will be found in time. So if we take away the initial knee-jerk, do you think it is justified that markets are falling?
Yes, I do. You have a cumulative effect hitting on the markets. One is the potential growth scare that began last week with a package of data that worried the market to see whether the Fed was perhaps behind the curve. Then you have on top of that concerns about the individual stocks, with Berkshire Hathaway, for example, selling another major tranche of Apple, despite the fact that Apple actually did quite well in the earnings call. And the question then is, what are they seeing about the markets? What are they seeing about the economy? And then on top of all of that, you have other questions about big tech, as we've heard, about the integration of generative AI, despite all of the money that they're spending in terms of capital expenditures. And then, as you pointed out, Richard, the NVIDIA today coming out early in the morning suggesting that they are going to delay a major shipment of their chips because of a problem. So all of this combined, and then, as you know, then on top of that, you get the margin calls. On top of that, you get the carry trade out of the yen, spooking the market. And you have then the Bank of Japan suddenly over the last week becoming much more hawkish, again, helping to push down the yen vis-a-vis the dollar.
Right.
All of this combined.
Now, on the other side, you've got a US economy that is fundamentally sound. You have a banking system that is robust, well capitalized, with strong reserves. So to make any comparisons with 2008, for example, or even post-pandemic, would be somewhat stretching it.
Absolutely. I mean, exactly what you had then, it was leverage. Remember, it was the hedge funds, it was the proprietary trading desks with tremendous leverage based on those subprime mortgage packages. And that just exploded to the downside, and the contagion was dramatic. No, that is not the case now. And markets do, shoot to the upside too much and to the downside too much. It's not to say that we won't have more. We probably will. But the market will find that equilibrium. That's the market's job.
And the Fed, do you think the Fed can wait till September before it does whatever it's going to do?
I think it's going to be difficult, especially if we continue to see the unemployment rate continue to climb higher. He'll have a number of reports, once a month. But we also have every Thursday morning at 8:30 Eastern, the initial unemployment claims and continuing claims, and they are rising. And the continuing claims rising because people cannot find jobs.
Can I suggest to you that this was inevitable? What we are seeing now is exactly what was always going to happen. If you have 11 increases in interest rates within a 2-year period, nearly 2,000% in basically interest rates. You know, inflation comes down initially first because that's the leading part of it, but job losses was always going to be part of the equation.
Absolutely. And it took a while, but the link between the job losses and consumer spending, and remember, the consumer is 68% of the US GDP, US economy. That link is intact. And if you start seeing the unemployment rate continuing to rise, the headline suggesting it's difficult to get another job, consumers are going to pull back even more.
If you accept that markets over time might be well balanced and finely tuned, but in the immediate bit, they're not. They always react, as you were just saying. Can the Fed, a cut now with monetary lag, a cut, 3 cuts before the end of the year, won't really have an effect until mid to next year. So the cake is baked for what happens next.
Well, the response is now a little bit quicker than it used to be. The 9 to 12 months it takes to work its way into the economy, either a rate hike or a rate cut, because they will do a verbal intervention most likely as they come out and speak this week. They're probably organizing an orchestrated response to this market pressure for them to do something. And also what's interesting is if you listen to who is going after the Fed to come out and cut rates, regardless if it's in between meetings, it's not the traders. They are senior economists. They are people who had senior jobs at the Fed. Actually, they are the ones that are coming out and saying, you are behind the curve now. You should have cut rates last week.
Ironic, isn't it?
And there's chatter, Richard.
Yeah, but ironic. They were behind the curve going into it, seriously behind the curve. And they arguably are seriously behind the curve coming out. I'm good to see. How kind of you for giving us time on what must be a very busy day for you as well. I'm grateful. Thank you, Quincy. Thank you.